Russia's revenue from oil exports has registered a significant decline, reaching its lowest point since the beginning of the war in Ukraine. New findings from the International Energy Agency indicate that Moscow's earnings from both crude oil and refined products fell sharply in November, reflecting a combination of reduced export volumes, lower global prices, and intensified pressure from sanctions and military-related disruptions. The agency reports that Russia's exports dropped by 420,000 barrels per day, bringing overall volumes down to 6.9 million barrels per day in November. This includes reductions of 290,000 barrels per day in crude oil exports and 130,000 barrels per day in refined product shipments. According to the IEA's assessment, the reduction in export volumes, combined with lower prices, caused revenues to fall to $11 billion, or $3.6 billion year-on-year, and $11.4 billion below the average for the first half of 2022, after the invasion of Ukraine. These figures underscore the financial strain facing Russia, the world's third-largest oil producer, at a time when state finances are already under pressure from weak economic growth, elevated military spending, and persistent inflation. Fossil fuel revenues play a central role in Moscow's budget, but the combined weight of sanctions and wartime disruptions is reducing the government's fiscal room to maneuver. At the Lukoil Neftochim refinery near the village of Kameno in Bulgaria, wide and medium shots capture the scale of one of the region's most significant energy facilities. The refinery appears in continuous operation, a reminder of the complex network that once enabled Russian oil to reach European markets before sanctions drastically reshaped trade flows. Nearby, additional footage from Burgas on Bulgaria's Black Sea coast shows the Italian tanker Shogun docked at the refinery port in early 2022, illustrating how European deliveries continued before embargo measures took full effect. Images from Greece, recorded in May 2022, depict the Russian-flagged tanker Lana transferring crude to the Liberian-flagged Ice Energy, following restrictions on Russian maritime deliveries. Such ship-to-ship transfers became a hallmark of the shadow transport methods used to maintain exports despite sanctions. In Liverpool, aerial images show the German-flagged ship Sea Cod stationed on the River Mersey near the Tranmere oil terminal. The vessel was unable to unload Russian oil due to embargo rules in place at the time, reflecting the early enforcement mechanisms that limited Moscow's access to traditional markets. These scenes illustrate the gradual tightening of international energy restrictions, which now form a key background to Russia's declining revenues. More recent footage from December 2025 highlights a further dimension of pressure on Russia's energy networks. According to the Ukrainian Security Service, explosions struck a Russian Shadow Fleet tanker named Dashin in the Black Sea. The recordings show traveling shots of the blast, followed by medium-range views of the damaged vessel. Ukrainian authorities claim the tanker was targeted by a drone strike, a type of attack that has increasingly disrupted Russian logistics and contributed to supply chain instability. Additional images from the Burgas refinery area show oil reservoir facilities, reinforcing the infrastructure's role in regional supply flows. Though located outside Russia, these facilities demonstrate the broader network of storage and processing assets affected by shifting trade patterns since the invasion. From Moscow, general and medium shots of Red Square capture daily civilian activity and the Kremlin's central government district. The images are a visual reminder of the political authority managing the economic challenges now confronting the Russian state. A Russian flag atop the Kremlin Senate building signals the continuity of government amid fiscal adjustments and rising budgetary strain. The Russian Finance Ministry has confirmed that oil and gas revenues declined in the first 9 months of the year. This drop comes alongside increasing military expenditures and domestic economic effects of sanctions. Moscow is projected to record a budget deficit of approximately $50 billion in 2025, equivalent to roughly 3% of GDP. The government plans to introduce tax increases on consumers and businesses in 2026 in an effort to reduce the fiscal shortfall. Ukrainian attacks on Russian energy facilities have also intensified financial and logistical pressures. Disruptions to refineries and storage sites have contributed to rising gasoline prices inside Russia, prompting temporary regional rationing in several areas. Such measures indicate both supply vulnerabilities and the broader economic impact of targeting infrastructure connected to the war effort. Another contributing factor is the international push to restrict Russia's ability to rely on alternative export pathways. In October, the United States enacted some of its toughest sanctions to date on the Russian energy sector, targeting Rosneft and Lukoil, the country's two largest oil companies. These measures aim to disrupt revenue streams that support Moscow's ongoing military operations and to enforce greater compliance with global price caps and embargoes. The IEA report notes that the combination of sanctions, reduced global prices, and logistical challenges has brought Russia's oil export revenues to levels not seen since before the COVID-19 pandemic. For comparison, the current figures fall well below the revenue levels recorded during the early months of the invasion, when elevated global oil prices temporarily bolstered Moscow's earnings. The broader context includes Russia's reliance on a so-called shadow fleet of older tankers operating with limited transparency to circumvent restrictions on insurance, financing, and port access. Attacks like the one reported on the tanker Dashin illustrate the risks tied to this strategy, with Ukraine increasingly targeting vessels believed to be involved in sanction evasion or military resupply operations. Despite these pressures, Russia continues to export significant volumes of crude oil and refined products, often redirecting flows towards Asia and other markets outside the sanctioning coalition. However, the IEA's data suggests the economic sustainability of these alternatives is being challenged by price fluctuations and by tightening enforcement from the United States and its partners. The report notes that the drop in export volumes was a major contributing factor to November's revenue decline, suggesting that logistical and operational difficulties may now be interfering with Russia's ability to maintain consistent output levels. These constraints include infrastructure damage, higher transport costs, the loss of Western service providers, and the need to operate less efficient shipping routes. As Russia faces a widening fiscal gap, discussions inside Moscow have turned to the likelihood of increased taxation in 2026. Revenue raised from new consumer and business taxes is intended to stabilize the budget, but analysts note that the decline in oil revenues poses structural challenges that may extend beyond temporary tax reforms. Sustaining military operations, managing inflation, and addressing declining household purchasing power all place additional strain on federal finances. The images from Moscow's Red Square highlight the contrast between everyday normalcy and the broader economic pressures shaping government policy. While daily life visibly continues, the Kremlin is preparing to manage constrained revenues at a time when external and internal demands on the state budget are rising concurrently. Meanwhile, European and NATO-aligned countries continue applying sanctions gradually designed to narrow Russia's export capacity while increasing the compliance costs associated with global oil trading. Restrictions on shipping services, insurance contracts, and technology access have all contributed to this trend. The IEA's warning that Russia's current oil revenue levels are now significantly below the average recorded in 2022 reflects how sustained international efforts have reshaped the country's economic landscape. Although Russia remains one of the world's largest energy suppliers, the downward trajectory in revenue signals a long-term financial challenge aggravated by wartime expenditures and structural sanctions. Across Bulgaria, Greece, and the United Kingdom, earlier footage of tanker activity and embargo-related restrictions offers a reminder of how Europe's transition away from Russian oil unfolded step by step. This shift has forced Russia to rely increasingly on more distant markets and unconventional shipping methods. As enforcement tightens, the effectiveness of these alternatives continues to be tested. In the coming months, energy analysts will continue to monitor whether Russia can stabilize its export volumes and whether global oil prices will shift in ways that might offset current declines. The interplay between sanctions, military developments, and market forces remains central to the outlook for Russia's energy revenues and for its ability to fund ongoing budgetary commitments. For now, the latest report shows that Russia's oil export revenue has fallen to its